to Taking Stock. This is the show where we take stock of the week gone by and prepare you for the coming week. I am Reema Tendulkar and with me is Anuj Singhal. Anuj, Friday correction notwithstanding, it was still a great week for our markets. We scaled at 9,400 mark for the first time ever, record levels on all the key indices.
Oh yes, so, the bulls are in control of this market. You could look at Friday and say things are turning a bit awry, but you know what? The markets gave record weekly close, and I think that's something which is interesting. Yes, on Friday, the Bank Nifty showed signs of tiredness. Actually, Bank Nifty has been showing some signs of tiredness, Reema, for last 3 or 4 days. I don't know if it's trend reversal or early trend reversal or anything else, but IT stocks are beginning to rally. So there are a couple of engines which are firing for this market, but just keep an eye on the mid caps. They run up a lot, due for correction. I think you maybe saw a bit of that on Friday, but then liquidity is just way too strong, and all of this could turn on its head once again Monday morning, and the market could resume its rally because right now there's just too much money chasing stocks.
Yes, liquidity is so strong that we had a blast of issuances. The 1,200 crore HUDCO IPO got subscribed 80 times. Not just that, the Kotak Mahindra Bank Delta QIP closed successfully in the week gone by. And despite that, the Nifty and the mid-cap index closed with gains of over 1%. But we'll discuss all this and more in the next 30 minutes. Let's tell you what we've lined up for you on the show. Well, to discuss the week on Dalal Street, we have with us Nilesh Shah, the MD at Kotak Mahindra Asset Management, and to discuss the technicals as well and to answer all our viewer stock queries, we have ashwinigujaral.com. But before we go across to them, let's take a look at the market headlines of the week. The bulls are in firm control on Dalal Street. This week saw the Nifty hit the 9,400 mark for the first time ever. All the major indices also closed at record levels. The markets lost some ground in Friday. The positive monsoon forecast as well as the strong FI buying aided the market sentiment. Auto, IT and consumption stocks led the gains.
The big gainers this week include Eicher Motors and Bharti Airtel. Both stocks gain on back of strong Q4 numbers. Kotak Mahindra Bank also saw some gains after the announcement of its fundraising drive, while a strong guidance from the Hero Motor management saw the company also post strong gains this week.
And Yes Bank's annual report shows divergence in bad loan declarations. The bank reported only 0.76% for the year ending March 2016, while RBI standards show the gross NPA should have been at 5%. Analysts find similar mismatch in Axis and ICICI Bank, which were declared in their earnings conference call. Private sector banks take a knock in trade.
Okay, let's invite our first guest on the show. Nilesh Shah of Kotak Mahindra Asset Management is with us now. Nilesh, always good to have you on the show. You describe yourself as, when I asked you whether you are, pessimist or optimist, you said you are a realist. Right now, what's good for the market? Do you think this market needs to correct from here? Are you deploying fresh money here? Because, money is just pouring in and you have to do it. So, what's the call here now at these levels?
So I have just returned from 2 days trip to Baroda in Ahmedabad, and clearly my cousin brothers have started advising me which stock to buy and how they will increase in value, and they are turning out to be right. These are the typical signs where one can believe that markets have started becoming frothy. So in the penny stocks, definitely there is some amount of froth coming in. You have started seeing SMSs coming to you, by this stock it will double by so and so day, and so on and so forth. There is probably also a demand for F&O leverage by inexperienced speculators. So this is typically again a weak point in the market. So I will advise caution on penny stocks. I'll advise caution on leveraged positions in futures and options by inexperienced people. At the same time, I also returned from about 12 days trip to East Coast in US, and there I saw for the first time number of attendees in our meetings expanding from 1 or 2 to 4 or 5. Second, I saw higher appetite for single country fund for India like it exists for China. It doesn't mean that money will start coming in tomorrow, but people are open, and if we work hard, we should be able to get India dedicated money. Third, I saw family offices, endowment funds, fund of funds, all gearing towards higher allocation to India, provided they can pick up, bottom-up stocks. So on a top-down basis, on a 5-year, 10-year view basis, they all are extremely bullish on India, but they need to be given appropriate stocks. It's almost like what Mr. Warren Buffett commented that, look, I am interested in India provided I can get a big deal. So in the shorter term, there are pockets of market, especially in penny stocks and leverage position, where there is need to be a little bit cautious. In the longer end, we do see increased allocation from FII, provided we can provide them bottom-up opportunities.
So Nilesh, that is the question then. How do we find these bottom-up stories now? How does one generate alpha? You told us about the stocks which we should perhaps avoid at these levels, the penny stocks, the leverage stocks, etc. But where does one deploy money then? What should be the approach to generate alpha now?
So first we must accept that this is no longer the first day betting pitch. It is the 5th day pitch. So one will have to be cautious. You can't be hitting every ball for a 4 and 6. You'll have to place out your inning. So do remember that pitch has changed. We still believe the opportunity is there in the space where one, government is spending money from budgetary allocation, and hence there will be growth. Second could be operating leverage stories. Clearly now there is enough liquidity in banking system, but credit growth has come down to a low level, and hence demand to some extent has been impacted. But companies are running their plants at 65-70% capacity utilization. If over a period of time, because of the banking liquidity and expanding credit growth, demand picks up, then the same plants will start running at 70, 75 and 80% capacity utilization. The profit margin of 65% utilization is substantially lower than what will be available at 80% utilization. So go for operating leverage companies. The third could be a bigger, longer term trend which is visible today in the market, and which I had talked earlier also, the shift of business or market share from unorganized sector to organized sector. Clearly, brand consciousness of Indian consumers, demonetization impacting trade payment channels, and the likely rollout of GST, these are all factors which are increasing organized sector's market share vis-a-vis unorganized sector's market share. So you'll have to build a scenario for future and invest. If your scenario building is correct, then you can still make money in this market. This market is similar to 2007 end or 2008 beginning, where from 21,000 markets indeed corrected substantially, but if you had picked up stocks in IT and pharma sector on a bottom-up basis, they all outperformed the fall by a significant margin. So stock selection is key, stock picking is key, and you must now pay for the future by building appropriate scenario.
You are sounding alarm bells here, Nilesh, because a lot of people think that yes, maybe we are in a bit of an over exuberance, but not quite yet in 2007 and or 2008 kind of zone, maybe more in 2003-4 kind of zone.
Certainly. No, certainly, Anuj, I didn't want to convey in terms of valuation.
Okay, sure.
All I want to convey is that even in 2007-2008 high valuation, which was substantially higher than today, stock picking delivered return.
Okay.
The same scenario applies today also. So
okay.
I'm not at all saying that we are in expensive bubble zone.
Okay, not an expensive bubble yet. But Nilesh, what did you make of the news flow on banks? On Friday, where there's some divergence between the NPAs as declared by the banks and as recognized by the RBI. Your thoughts on that?
So one, servicing of the instrument or a loan vis-a-vis security of the instrument or a loan is completely different. A loan can become NPA because it is not getting serviced properly. but it doesn't mean that it has to be written off provided you have appropriate security in your hand, and more importantly you have ability to enforce it. So my feeling is that in many of the private sector banks, while RBI's assessment of NPA is substantially higher than the management's assessment, it is not that everything assessed by RBI is going to be written off. These are secured loans, and one can definitely enforce security to recover the loans. I'm sure all of you would have read a WhatsApp message which is being circulated that largest ever fire sale is going on in India Inc. And we have seen that once the assets get sold, it moves from weaker hand to stronger hand, then debt servicing does start happening. So the truth lies somewhere in between what management has projected versus what RBI has assessed.
Okay. Just one final question then. How have the earnings been for you so far? Has it been better than what you were anticipating? And do the FY18 estimates look optimistic then or not?
So one thing, clearly the broad market numbers are getting vitiated by what one bank suddenly decides to provide in terms of NPA. I mean, for example, a large consumer durable, company suddenly got classified as NPA in one of the bank. Now, this kind of one-off events does impact overall broad market earnings quite significantly. We are more focused in our portfolios, and here so far the earning numbers which have come, and majority of them have already come, the numbers are more or less little bit ahead of our expectation. The earnings are also pointing out clearly that the effect of demonetization is now behind. Companies have recovered well, consumer confidence have bounced back, and clearly the future looks little bit better. The management commentary is becoming little bit positive. Of course, everyone wants to put a caveat, and the caveat for us going forward is the rollout of GST. While government does mention that it will be revenue neutral, but within revenue neutrality there could be significant deviation in company to company and sector to sector. So subject to efficient rollout of GST not impacting businesses, managements have become more positive.
Okay, Nilesh, always good talking to you. Thanks a lot for your time today and have a good weekend.
Thank you.
That's the view from Nilesh Shah of Kotak. Well, we'll take a break, but don't forget we have a brand new segment on taking stock where you can tweet your stock queries and Ashwini Gujral will answer them. So you can tweet your queries to CNBC TV 18 live with hashtag AskCNBCTV18. While you do that, we'll take a short break, and here's some of the market opinion that we received all through this week. We'll come back with Ashwini Gujral.
I think what the markets are probably trying to kind of factor in is a potential earnings recovery over the next 1 or 2 years, and that earnings recovery will have to be substantial. If that doesn't happen, then of course, these valuations will not sustain. The pack like auto ancillaries, industrial consumables, quality logistics companies, these are the kind of companies where I think the earnings growth will be probably way ahead of aggregate earnings, or way ahead of the overall earnings situation. And I think it still makes sense to kind of look at these kind of pockets and be invested into them.
I think in India, if you see, we invest more money in gold than we invest in equities. And that is a very big mistake that the entire country has been making. So foreign ownership of Indian equities has gone up from 0% to 24% in last 25 odd years. So who has sold those stocks? Indians have sold that stock, right? And what have we done with the dollars that we get by selling our stock? We have been importing gold. So we have been, without realizing it, reducing exposure to an asset which gives 15-20% per annum and moving into an asset which gives you single-digit returns. So I think the key is asset allocation. You must appreciate the compounding potential of equities.
I am particularly quite positive, for instance, in the tourism sector. Obviously, affordable housing, anything to do with whether you are part of affordable housing in terms of what you are doing to build those houses, or you are in the financing area. That sector again looks quite promising.
this move beyond 9,000 is a little more measured, which I think is really positive, because the market is telling you that it doesn't want to run ahead of itself. I think from a near-term perspective, we have been working with 9,500 as a target. We are almost within striking distance of that. And there are certain technical studies which suggest that around the 9,500 mark, there could be a pit stop. So wouldn't be surprised if there is a smallish correction from around those levels. But barring that, I think once the Nifty gets past this particular level, I think that would really open up another 4 to 5% on the upside.
And at valuations where we are, the risk, remain a little bit elevated, particularly when you could have the implementation of GST, which again, I reiterate, could have has the potential to disrupt the economy for at least 3 months, if not 6. So I don't see this year as being a big earnings pickup, even if the monsoons are better than expected. But I really wouldn't say that's the real reason for the markets to move higher. I still think what we're seeing at the moment is, bad news is good news, and good news is great news.